many people think, okay, so you're assuming that institutional investors become huge holders of Bitcoin. No, we're not. We're assuming, though, that they will move in gradually, and by the time we hit $1 million plus, they will have a 2.5% exposure to Bitcoin. Now, this is such a big idea, and that is such a small allocation.
Yeah.
I think they will regret not having more because, as I mentioned, this is the first, each word I'm about to say is really important. The first global, big idea, private, meaning not overseen by any government, digital, rules-based monetary system. It is a big idea, and my mentor, Art Laffer, when he was collaborating with us on our first white paper in 2015 on Bitcoin, he said, this is what I've been looking for, a rules-based monetary policy. It might not be the right rule, but it's a step in the right direction. And of course, he means by that it's a great store of value because it's mathematically metered to stop at 21 million units, so that's a quantity rule. So great store of value, scarcity meaning, but not a great means of exchange, right? That would mean a flat price rule. But we think over time, even that will, thanks to the Lightning Network, become more of a means of exchange and a unit of account, playing all three roles of money. When Art and I and Chris Berniski at the time, our analyst, were collaborating, I remember saying, Art, how big could this be? This is amazing. And he said, well, how big is the U.S. monetary base? And back then it was $4.5 trillion, and Bitcoin was $6 billion in market cap. Today it's $800 billion. He said, well, $4.5 trillion. Today, that number is $9 trillion. So, it's a very big idea. Bitcoin mining as part of utility ecosystems is going to accelerate the shift towards renewables. And the genomic revolution is going to help us grow food in areas maybe away from Ukraine, as it's in quite a bit of turmoil, in other areas that are not as friendly environmentally to food production. So innovation solves problems. That's all we do. We've got a lot of problems, and inflation is another problem. We don't think it's going to be long-lasting, but if it is, and if one of the reasons is a labor shortage, automation, artificial intelligence, robotics solves problems. I think you'd be shocked to see how calm and focused everyone is. We're focused on our research. Are we getting this right? We have a 5-year investment time horizon. So if you look at the last 5 years, including the first quarter waterfall performance, the last 5 years we have handily outperformed the NASDAQ, the S&P. So 5-year time horizon is not just looking back, but looking forward as well. And putting this recent performance into perspective, you'll note that during COVID, so from April, whenever the market bottomed, through February of 21, our flagship strategy was up almost 360%. No, I'm sorry. Yeah, 360%. Down 60% from that at our worst. Very tough. And, I'm thinking about our clients, and I've been extremely gratified, we all have, that for the most part they've stuck with us. Last year, our net inflows were $17 billion. Most of that weighted at the beginning of the year. And so they have felt the full force of this decline. And yet we inflowed last year, and we're inflowing this year. I think that has been shocking to a lot of our counterparts out there who have gone through periods like we've just experienced and have had massive outflows. And I think a few things are at work. Number one, our long-term time horizon is practically the first thing we say when we're talking to prospective investors. Number two, if I were to have told you in February, or talked to you in February of 21, even at that point in time, given our projections for the next 5 years, we expected our flagship strategy to deliver a 15% compound annual rate of return, so about double the market over time. Today, after this decline, our projections have, if anything, they've increased because artificial intelligence breakthroughs are moving so much faster than we expected. So our expectations for future returns have gone up as the prices have come down. So today, we expect, now consider the source. This is our research and these are our expectations. And we could be wrong. But whereas it was 15% last February, that number today is 50%. 50% at a compound annual rate. And it's because what we believe the market does not understand is we have entered the sweet spot of exponential growth trajectories. Most of the market thinks in linear terms. Most of our careers, we've experienced primarily linear growth, growth that slows down, decays to the nominal GDP growth rate over time. We have a few experiences with exponential growth. Amazon is a very big one. When we were buying Amazon in 2003, what we were saying to investors is, if you believed Amazon could grow anywhere in the 20 to 30% range for the next 20 years, would you buy it? You put that into a dividend discount model, you would buy that all day long. But that's not how people were thinking about it.
Well, and as you're talking, you effectively have to retrain investors, right? Investors over the past decade, 2 decades, have been trained to expect that pop, to expect short-term returns. How do you retrain them to focus more on the longer term, especially when there can be a lot of short-term pain?
Yes. Well, I think the market is going to train them over time now. So over the last 20 years, as you say, the market has outperformed the majority of active investors, the vast majority. And so that is career risk for a lot of, so we've had now a lot of benchmark hugging because it's been the right place to be, the markets, right? The broad-based indices. If we're right on the amount of disruptive innovation that is going to disturb the traditional world order, the broad-based benchmarks are not going to be the place to be. Now, they'll always be tried and true. There are some stocks that are going to be able to weather all of the disruptive innovation that we see because they have great management teams. But so many companies in the broad-based benchmarks have gotten used to giving investors a little adrenaline with manufactured earnings, share buybacks, or increasing dividends. And they've leveraged up to do that, and they have not invested enough in innovation. For the kind of innovation to participate in it, in the innovation we see ahead, companies have to sacrifice short-term profitability and invest aggressively because we are in a lot of winner-take-most opportunities because of artificial intelligence. So if we're right, then in between now and 2030, this is in our big ideas on our website, between now and 2030, the market cap associated with truly disruptive innovation is going to move from $10 trillion today, which is less than 10% of the market, to $210 trillion. This is just in 8 years.